Shorting stocks means you're trying to profit from a price decline instead of a rise. Instead of buy low, sell high, you're effectively selling high first, then buying back lower. Here's the full breakdown from basics to advanced. Number one, how shorting actually works. When you short a stock, 1. Your broker borrows shares from someone else. 2. You sell those borrowed shares at the current market price. 3. If the price drops, you buy them back cheaper. 4. You return the shares and keep the difference, minus fees. Example, short at $100. Stock drops to $70. Buy back at $70. Profit equals $30 per share before fees. If it goes up instead, short at $100. Stock rises to $140. Buy back at $140. Loss equals $40 per share. Number 2. The biggest difference versus buying, very important, is the core risk difference between going long and short. It's not just theoretical, it directly changes how you manage trades. When you go long a stock, you pay cash to own shares. The lowest the stock can go is $0, so your maximum loss is limited. Example, buy at $100, stock goes to 0, loss equal $100 per share. You cannot lose more than what you invested, but your upside is unlimited. $100, $200, $500, $1,000. There's no ceiling. Now compare that with short selling. When you short a stock, you sell borrowed shares first. You must buy them back later. If price rises, your loss keeps increasing. Example, short at $100. Stock rises to $200, loss $100. Stock rises to $300, loss $200. Stock rises to $1,000, loss $900. There is no theoretical cap on how high a stock can go, which means your loss is technically unlimited. This creates 3 important implications. First, risk grows faster against you. When long, a stock dropping 20% hurts but doesn't accelerate. When short, a fast squeeze upward can move 20%, 40%, 80% in minutes. Second, short trades require tighter stops. Because losses expand quickly, many traders use smaller position sizes, exit faster, avoid holding overnight. Third, psychology is harder. When long, price dropping feels temporary. When short, price rising creates urgency because risk expands with every move up. Here's a side-by-side comparison. Going long, max loss, limited. Max gain, unlimited. Risk direction, downward. Time pressure, lower. Short selling, max loss, unlimited. Max gain, limited, 100%. Risk direction, upward. Time pressure, higher. Another subtle but important point, profit potential is capped when shorting. If you short at $100, the best possible outcome is the stock goes to 0. Maximum profit equal $100 per share. But when buying at $100, it can go to $200, $300, $500, etc. So shorting has limited upside, unlimited downside, which is the opposite of buying. This is why many experienced traders short less frequently, use smaller size, take profits quicker, avoid holding shorts long term. Shorting can still be very effective, especially in bear markets, parabolic spikes, weak stocks. But the risk profile forces stricter discipline than long trading. Now 3, margin requirement. Shorting requires a margin account. Brokers require minimum equity, maintenance margin, possible margin calls. If the stock rises too much, your broker may force close your position, buy back at a loss. 4, short squeeze, critical concept. One of the most important and dangerous concepts in short selling. What a short squeeze actually is. A short squeeze happens when many traders are shorting a stock. The price starts rising instead of falling. Short sellers begin buying back shares to exit. That buying pushes price even higher. More shorts panic and cover. The cycle repeats. This creates rapid, vertical price moves upward. It's called a squeeze because short sellers are forced to buy, which squeezes them out of positions. Why short squeezes move so fast? Short squeezes are powerful because they combine normal buyers entering, short sellers forced to buy, stop losses triggering, margin calls forcing exits. All of these create buying pressure at the same time. Normally, buyers push price up slowly. During a squeeze, buyers plus trapped shorts push price explosively. Real-world examples. Two well-known squeezes, GameStop 2021, AMC Entertainment 2021. Both had extremely high short interest, retail buying momentum, shorts forced to cover, massive multi-day rallies. What short interest means. Short interest equals percentage of shares currently shorted. General interpretation, under 10% normal, 10 to 20% elevated, 20 to 40% high squeeze potential, 44% plus, very dangerous for shorts. The higher the short interest, the more fuel for a squeeze. Float size makes squeezes worse. Low float stocks squeeze harder. Float equals number of tradable shares. Low float plus high short interest equals limited supply, high demand from covering shorts, violent price spikes. That's why small cap stocks are riskier to short. Signs a short squeeze may start. Common warning signals, strong move up on high volume, breaking key resistance levels, no pullbacks, increasing buying pressure, news catalyst, high short interest. If you're short and see these, risk increases quickly. Anatomy of a squeeze. Typical sequence. 1. Stock runs up unexpectedly. 2. Early shorts start covering. 3. Price accelerates. 4. Stops trigger. 5. Margin calls hit. 6. Panic buying from shorts. 7. Vertical spike, often followed by sharp pullback after squeeze ends. Why beginners get caught. Common mistake. Shorting a stock after it already moved up a lot. They assume it's too high, it must fall. But shorts pile in, price keeps rising, squeeze begins. This traps new short sellers. How traders reduce squeeze risk. Experienced traders often avoid shorting low float stocks. Avoid high short interest stocks. Use smaller position size, tight stop losses. Avoid holding overnight. Wait for confirmed weakness. Short squeeze versus normal rally. Normal rally, gradual upward movement, pullbacks, controlled volume. Short squeeze, sudden vertical move, few pullbacks, extremely high volume, rapid candles. You can often see the difference visually. Why squeezes are dangerous. If you're short, losses increase as price rises. Your exit requires buying. Your buying pushes price higher. That worsens your loss. This feedback loop is what makes squeezes so violent. Many professional traders say, shorting is profitable until the squeeze. Understanding squeezes is one of the most important skills for managing short positions. Number 5, borrow fees and availability. You must borrow shares to short. Easy to borrow equals low fee. Hard to borrow equals high fee. No shares available cannot short. Borrow fee can range 0.1% annually, large caps, 20 cents plus annually, small cap runners. This fee reduces profit over time. Measure 6. When traders short stock, this is less about mechanics and more about context. Identifying situations where downside probability is higher. Shorting tends to work best when buyers are weakening or when price is overextended. Traders look for specific environments. First, overextended parabolic moves. This happens when a stock rises very quickly in a short time. The move is often driven by momentum and emotion rather than sustainable demand. Eventually, buyers get exhausted. When the first signs of slowing appear, smaller candles, long upper wicks, declining volume, traders start looking for short entries. The logic is mean reversion. Extreme moves often retrace. Second, failed breakouts. A stock breaks above resistance, attracting buyers. But instead of continuing higher, price falls back below the breakout level. This traps buyers who entered late. Those traders often sell to exit, creating downward pressure. Short sellers use this trapped liquidity as an opportunity. Third, lower highs in a downtrend. In a downtrend, price structure forms. Lower highs, lower lows. When price rallies but fails to reach the previous high, it shows sellers remain in control. Many traders short at the lower high because risk can be defined above the recent peak. Fourth, resistance rejection. A stock approaches a known resistance level, previous high, moving average, VWAP, trend line. If price touches the level and immediately rejects long upper wick, heavy selling, traders interpret that as sellers defending the level. This becomes a common short setup. Fifth, weak earnings reactions. Sometimes a company reports earnings, but instead of rallying, the stock sells off. This indicates expectations were too high. Institutions are selling. Demand is weak. Traders often short after the initial bounce fails, expecting continuation lower. Sixth, bear market continuation. Shorting tends to be more effective when the overall market is weak. In bearish conditions, rallies are often temporary. Sellers dominate. Breakdowns follow through more reliably. Many traders prefer shorting only when the broader market trend supports it. Another scenario is gap up fade. A stock gaps higher at the open but cannot hold the gains. Early buyers take profits and shorts enter. If price falls below the opening range, it often continues lower intraday. There is also momentum exhaustion. After multiple strong bullish candles, volume spikes but price stops advancing. This suggests buyers are no longer pushing price higher. Short sellers interpret this as distribution. A key idea across all these scenarios is confirmation of weakness. Experienced traders usually wait for breakdown of support, lower high formation, rejection candle, volume shift. They rarely short purely because something looks high, conditions that make shorting more favorable. Weak overall market, high relative weakness versus index, overbought technical indicators, increasing selling volume, news catalyst that fades. Conditions that make shorting harder, strong bull market, low float stocks, high short interest, strong upward momentum. Major positive news. Many traders also look for confluence, meaning multiple signals at once. For example, parabolic run, resistance level, RSI overbought, lower high forming one. When several factors align, probability improves. In practice, shorting is often about timing the shift from buying pressure to selling pressure, rather than predicting the top. 7. Popular shorting strategy. These are structured ways traders consistently look for downside setups. Each relies on a different market behavior. Trend continuation shorts. This is one of the most consistent approaches. The idea is simple: short within an existing downtrend, not against it. Traders identify lower highs and lower lows, then wait for a bounce that fails. Entry often happens when price rejects resistance or breaks below a small consolidation. Risk is usually placed just above the recent lower high. This works best in weak markets because rallies tend to fail rather than continue. A common pattern inside this category is the bear flag. After a sharp drop, price moves sideways or slightly upward in a tight channel. This pause represents temporary relief buying. When price breaks below the flag, sellers often return. Traders short the breakdown expecting continuation of the initial move. Mean reversion shorts. These assume price has moved too far too fast and will revert toward an average. Traders look for parabolic moves, overbought conditions, or extreme gaps. Entry usually occurs after the first sign of momentum slowing, such as long upper wicks, decreasing volume, or failure to make new highs. Because these trades go against the short-term trend, they typically require quick profit-taking and tight risk management. A common example is the parabolic spike fade. A stock surges vertically, then stalls. Traders short price breaks below the most recent minor support. The expectation is a pullback toward VWAP, moving average, or prior consolidation. Momentum failure shorts. This strategy focuses on situations where bullish momentum collapses. The stock appears strong, then suddenly loses strength. Traders wait for failed breakout, VWAP rejection, opening range breakdown. For example, a stock breaks above resistance, attracting buyers. If it quickly drops back below the breakout level, those buyers become trapped. Their exits create downward pressure. Short sellers enter during the breakdown. Gap and fade strategy. This is common for day traders. A stock gaps up at the open but cannot hold the gains. Early strength fades as sellers step in. Traders often short when price drops below the opening range or VWAP. The expectation is that the gap will partially or fully fill. Lower high rejection. In a downtrend, price rallies but fails below the previous high. This forms a lower high. Traders short the rejection because it confirms sellers remain in control. This strategy provides clear risk placement above the recent high. VWAP rejection short. VWAP often acts as intraday resistance in weak stocks. When price moves above that but quickly falls back below it, traders interpret this as failed buying pressure. Shorts enter on the rejection expecting continuation lower. Each strategy has slightly different characteristics. Trend continuation, higher probability, slower moves. Mean reversion, faster moves, lower holding time. Momentum failure, sharp entries, strong follow-through. Gap fade, intraday focused, open volatility. Lower high, structure-based, clear risk levels. Many traders combine them. For example, gap up, momentum fails, lower high forms, VWAP rejection. This layered setup often increases probability. Risk management is essential across all strategies. Shorts often use smaller size, exit faster, avoid holding through news, take partial profits quickly. Because upward squeezes can occur at any time, discipline matters more than on long trades. Note 8. Technical signals often used for shorting. Common indicators. RSI of 70, overbought. VWAP rejection. Moving average resistance. Bearish divergence. Volume exhaustion. Lower highs pattern. 9. Best time frames for shorting, scalping. 1 min, 5 min, opening volatility. Day trading, 5 min, 15 min, VWAP setups. Swing trading, daily 4H trend breakdowns. 10. Risks unique to shorting, beyond normal trading risk. These are structural issues that make shorts behave differently from long positions. Unlimited loss potential. This is the primary risk. When short, losses grow as price rises, and there is no ceiling. A stock can double, triple, or move several 100%. Because you must eventually buy back shares, you cannot simply wait it out the same way some investors do when long. Rapid upside moves can cause severe drawdowns very quickly. Short squeezes. When many traders are short and price rises, forced covering creates a feedback loop of buying. This can lead to sudden vertical moves. Unlike normal rallies, squeezes often have minimal pullbacks, making it difficult to exit. Traders caught in squeezes often experience slippage, meaning they exit at much worse prices than expected. Borrow fees, cost to short. You pay to borrow shares. This is called the borrow rate or hard to borrow fee. The fee accrues daily and reduces profit. In extreme cases, borrow fees can become very high, making even a correct directional trade unprofitable if held too long. Forced buy-ins. Your broker can require you to close a short position if shares become unavailable to borrow. This can happen unexpectedly. When it occurs, the broker buys shares on your behalf regardless of price, which may lock in a loss. Margin calls. Short selling uses margin. If price rises and your account equity drops below requirements, the broker may demand additional funds. If you do not deposit capital, the position may be closed automatically. This often happens during fast squeezes. Low float volatility. Stocks with small floats move more aggressively because fewer shares are available. A small amount of buying pressure can move price significantly. Shorting these stocks increases the risk of sudden spikes. News risk. Positive news disproportionately hurts shorts. Examples include buyout rumors, strong earnings, analyst upgrades, FDA approvals, biotech, unexpected partnerships. These events can cause immediate large gaps upward, leaving little opportunity to exit. Gap risk overnight. Holding short positions overnight adds risk. Stocks can gap up significantly due to news or market sentiment. Because markets are closed, you cannot exit until the next session, often at unfavorable prices. Crowded trades. If too many traders are short the same stock, the trade becomes unstable. Even small upward moves can trigger widespread covering. Crowded shorts are more prone to squeezes and erratic behavior. Psychological pressure. Short positions often move against traders faster than long trades. This creates urgency and emotional decision making. Many traders exit too late because they expect the move to reverse, while risk continues increasing. Because of these risks, experienced traders often use smaller position sizes for shorts, avoid low float stocks, avoid holding overnight, take profits quicker, use tight stop losses, monitor borrow rates. Shorting can be effective, but the risk profile is structurally more aggressive, which is why discipline and risk control matter more than strategy alone. Nashem 11. Alternatives to shorting. If you don't want direct short risk, buy put options, inverse ETFs, bear spreads, trade inverse market funds. These cap risk more effectively. Measure 12. Basic shorting checklist. Many traders use something like stock extended, weak market, resistance nearby, volume decreasing, lower high formed, stop loss defined. If most are yes, then short setups are stronger. Number 13. Risk management rules for shorting. Common guidelines: smaller position size than longs, faster stop losses, take profits quicker, avoid low float squeezes, avoid shorting strong uptrends. Number 14. Beginner mistake to avoid. The most common error: shorting just because a stock is too high. Stocks can stay overbought for a long time. Better to wait for confirmation of weakness. If you're trading based on your earlier interest in strategies, the most consistent shorting setup for many traders is strong run up, lower high, VWAP rejection, breakdown with volume,